Greetings, everyone. This is Numan Khan. On behalf of SMB Capital, I would like to welcome you to an earnings call with Almarai's management regarding the company's Q2 25 earnings results. Representing the management today are Mr. Danko Maras, the company's CFO, Mr. Ikram Ul-Haq, Head of Finance, Almarai Group, Mr. Abdul Hadi, Head of Investor Relations. We'll first listen to the management feedback. Following this, we'll open the floor for the Q&A. Almarai's management, please begin your feedback.
Welcome to Almarai's second quarter 2025 earnings call. This is Abdul Hadi Al-Ami, Head of Investor Relations at Almarai. I'm here with Almarai CFO, Mr. Danko Maras, and Ikram Ul-Haq, the company's Head of Finance. First, I would like to thank SMB Capital for organizing and hosting this call, and to Numan Khan, our moderator. As usual, I assume that you will all have downloaded the Q2 2025 earnings presentation from our website. For those who haven't, please visit Almarai website. Under Corporate, you will find the Investor Relations button. Once you press Financial Information, you will see the earnings presentation as the last button on the right. In this folder, you will find the document. So should we start? Before we start our call, please pay attention to the disclaimer page. And now I will give the floor to Mr. Danko Maras.
Well, thank you very much. If we could go to the first page, thank you. So good morning and good day and good afternoon to all of you, ladies and gentlemen. I am happy to be with you again for the Q2 results reporting. And then I would please ask the team to put back into the first page where I will talk a little bit about the market dynamics first, and then the business performance, and then the financial performance in the second quarter. Sorry for that little glitch there on the presentation. We have a little bit more information also on the appendix that you can look at. I think it might be helpful in reviewing the numbers. But let me get right into it and talk about our market dynamics. So if we move to the page on the market share, thank you. So here you can see this is May month 2025. You can also see that our categories are either holding or growing shares in our market, and we remain number one in each of those markets, in each of those categories. It's great to see that we're holding position, especially in some of the categories that I will go more into a little bit later on. Moving into our innovation pipeline, if we can go to the page on innovation, please. We are not... Sorry for that glitch. So again, innovation pipeline, you see that we have key innovations in the quarter for our poultry business. Cooked chicken teriyaki, chicken butter, chicken barbecue, pepper yogurt flavors in poultry, good extensions that are selling very well. We have some extensions also in croissant butter and bakery. And we added another exciting variant in our ice cream portfolio. Mini Bites Caramel is selling very well. In addition to that, we are also launching a new umbrella brand that you can see there on the bottom. It's Yakult evaporated milk. It's something that represents young males and females passionate about cooking, taking pride in preparing delicious meals. So this Yakult umbrella brand is going to be, we're going to add some additional components in product offerings going forward, and the start has been very well in this particular category. So a joyful, good young females, males cooking umbrella brand that we have launched in the quarter. More to come on this for sure. And then if I can get some order in the slides here, please, then we move to the business performance for Q2. And overall, looking at it, how did we perform in the second quarter? There's a few points about Q1 and Q2 that I think is helpful for you, investor and analysts, to understand on Ramadan. So we will also show you the first half year and go through the impact of our performance so far without having any of those comparator issues. So bear with me, we'll come to that in a second. So growth, we have about 3% growth in the quarter, 134 million. So we're currently at 5,288 billion in the second quarter. It is our highest ever quarter in the last, I think, 13 quarters that we have represented the quarters. Most of the growth, or almost all of the growth, is volume related. And even though it's a little bit less than what we saw in the first quarter, it's all essentially volume growth that you're seeing in the quarter. Our operating profit increased with 3% or 20 million to 813 million. That represents an EBIT margin of about 15.4%, which is equal to what we actually had last year as well. Our net income is elevating a little bit further. So you see a growth of our net income of 4% up to 647 million. That's a 27 million increase. And it means that the net income margin that you're looking at in this quarter is 12.2% versus last year's 12%. So overall, solid performance on top line and the bottom line in terms of our growth components. Our working capital is increasing. You see there it's about 4 billion. You'll see that also in the first half year. We did a lot of activities of reducing our inventory. We had a special program last year. So you see a balance slightly higher. Most of that is actually credit sales that we did at the end of the period in our receivables. But in addition to that also, I do need to highlight that some of our ingredients, we are cautious and mindful that we have availability of supply given the geopolitical situation that has been happening to us in the surrounding area. So some of the ingredients might not be very large in quantities, but they are hard to get hold of or have a long lead time. So we have been a bit more cautious in ensuring the most important thing for us is the availability of supply and that we are able to sell. And we don't want to lose out on a specific ingredients. So we have increased inventory a little bit because of the situation that we're in. It's not significant or material. In bigger context, we can manage the working capital overall. And it seems that things have calmed down a little bit. We'll see how things are progressing over time. But we're keeping a close eye on the situation around us. Our capital investment continues to increase. So you see 1 billion spent in the quarter. We've said full year that we will be north of 4 billion. And it's just following our capital investment plan that we've announced earlier. And I'll speak more about that when we come to the first half year. So the resultant free cash flow in the quarter is negative from 748 last year, thanks to the working capital swing predominantly in capex. You see 383 million in the quarter. If I then move to the next page and start talking a little bit about the top line, you can see the revenue growth we have is 134 million, or the 3% that I referred to. A lion's share of that growth comes in KSA in absolute terms, 103 million or 3%. But you also see good growth coming from UAE, Kuwait, Jordan. Qatar has a very low base, so you see a lot of percentage movements, but we still have a way to go to get back to levels where we were in the past. But very positive to see the growth also in Qatar. If we look at Egypt, you see a negative growth in Egypt. And I think it's important to highlight that underlying currency, we have significant growth. We have over 30% growth in Egypt. But as we translate this into hard currency or SAR, it's a negative 5 million. And that continues also when we see the first half year. However, bottom line, we are managing that from a SAR point of view, and they have low single-digit EBIT margins. So they are delivering good profits. It's just the effect that you see on the devaluation. Some pricing activities will also happen in that area. So we will hopefully see some more growth also coming in SAR. Oman, we had a little glitch in the quarter that had to do with availability of supply. And so we had negative growth there, but there's nothing that we worry about. We have good profitability and good growth in Oman from previous year, and we will continue to focus and ensure that we will get that growth in that country. If we look at the categories, again, you see good delivery in the quarter, in particular on food and bakery. 12% growth on food, 65 million is very good. Bakery also 49 million or 8%. Long life dairy, fruit juice also delivering good growth in the quarter. Poultry, the underlying volume growth in poultry is double digits. So we have good volume growth in poultry, but we have worked on supporting the brand and the positioning with trade support. So it affects the gross to net, and therefore we only see a benign growth on the revenue component. But underlying the business is very healthy, and we are selling what we can produce, even though we have this impact in net revenue. Fresh dairy is negative with 31 million, and that comes down to the shift of the Ramadan, where we overall, when we look at the first half year, very good delivery of fresh dairy. But these are the effects of the Ramadan impact, where most of our sales during Ramadan comes within the fresh dairy segment. So the negative growth is not worrying us at all. If we look at the first half year, you'll see soon that it's very good delivery from fresh dairy. And then if we look at the channels, modern trade growing significantly in the quarter, 96 million, 8%. It's a lot of focus also here on the gross to net, making sure that we get return on our investments for the support that we are giving to the retail business. So one or two of you have asked questions about if this is sustainable. Our focus is very much into making sure that we get the right returns for our activities in modern trade. So very happy to see this, but much of it also comes from lower support or better optimization of our support structure to the activities that we do in modern trade. Traditional trade and food service are also delivering well in the quarter. The negative 39 million you see on export there is really related to farming, poultry farming, where we last year had a one-off benefit of selling some of our supplies to a third party. So it's not really the underlying product sale, it's just our farming division that had a benefit last year that we don't have this year. So all of this is also not significant in terms of margin contribution. So in effect, it's actually accretive in terms of the mix when we look at it. So that's the countries, channels, and categories. If we go a little bit more further into the financial performance, now you're flicking the pages again. Can you please go to the net income bridge? And I give the word to Ikram to speak about the financial performance.
Thank you very much, Danko. Sorry, our laptop is playing today, so do apologize for that. But give me 1 second to get to the right page. So let me talk about how our income grew by 4% from 620 million riyals. That's the pillar you can see on the left-hand side, to 647 million riyals, which is the pillar on the right-hand side. So there are 5 major key pillars, which has allowed us to grow our income by 4%. The number 1 is about net pricing, which is negative, which is what Danko alluded to, mainly driven by the poultry area, which we have seen some discounting in the market, followed by some discounting in the long life dairy. We haven't seen a change in the list pricing, but we have seen an increase in discounting, which is resulting in a 56 million drop in net income on a relative quarter-to-quarter basis. Cost of goods sold has remained benign over the quarter. This is actually 2 things offsetting each other. We are seeing savings in our cost of goods sold, driven by farming commodities, which is mainly soya, alfalfa. Those things are indeed coming down, but this is getting offset by increase in the dairy commodities, which is butter, cheese, and related products. Overall, it's a small difference of 10 million riyals, which is negative. The very positive thing is the 77 million growth, driven by a very positive 6% volume growth for the full quarter. We are seeing a very robust volume growth in the economy, and that is the effect that is resulting us in 77 million riyals of higher income for the quarter. The last two bars are small, but the effect is quite good. Operational cost is only 9 million riyals, slightly positive, but that shows our commitment to cost cutting, and I'll address that in the later pages. Followed by 7 million riyal lower funding costs, which is driven by higher capitalization due to the poultry projects ongoing. And this is how we go from 620 million in Q2 2024 to Q2 2025 of 647 million. Hopefully my computer doesn't play. Let me try one slide. Okay, worked. On this slide, we talk about the revenue growth, the operating profit, and the net income. Ladies and gentlemen, just remember three numbers. Almarai revenue went up by 3%, which Danko has talked in quite a lot of detail by channel, by country. Because of the revenue growth of 3%, our operating profit also went up by 3%. This is despite having very high transportation costs for the quarter. That shows our commitment to making sure we run a very tight ship. And because of the growth in operating profit, net income also grew by 4%, which is mainly due to lower capitalization. The higher capitalization of the interest cost that we're making. So three numbers, 3% top line, 3% operating profit growth, 4% net income growth. That's the key message for the Q2 for this line. And if I do the same numbers by different segments, on this slide I will discuss each segment one by one. If you look at the middle of the page, you look at dairy and juice, you'll see the big plus 3% growth rate. So our top line grew by 3%. Even though Ramadan was shifting by 10 days from Q2 to Q1. And we had the impact of the EGP devaluation. So that shows the strong growth that Danko talked about in foods and long life dairy as well. So the top line grew by 3%. When you look at the income growth, if you look at the bottom area, you see the rate of minus 1%. That's mainly driven by the lower economies of scale. Dairy is our big portion of our portfolio. And as we are shifting profits or shifting revenue from quarter to quarter because of Ramadan, there is a slight impact on the profitability. We will discuss the half-year numbers and you will see that the profitability is running very much in line with our expectation. Bakery growth top line is plus 8%. You can well imagine bakery is having a positive impact because of Ramadan phasing. People don't eat a lot of bread, as you can imagine, during Ramadan. And because of the phasing, just like we have a negative impact for dairy in Q2, we have a positive impact for bakery, plus 8% growth rate for the quarter. And correspondingly, income is also growing by 8% because of our very high economies of scale. Poultry, as Danko talked about, we are running at full capacity. We are selling whatever we are producing. And because of this higher efficiency, the top line is remaining flat because of our full capacity utilization, and the profit is also flat despite having higher transportation costs in this segment. And that's the story for Q2 by business segment. Danko, if I can please request you to take us through the highlight for the first half for Almarai.
Yeah, I'll see if I can try to speed it up a little bit. But again, you look at revenue, 4% growth in the first half year. We are now at 11 billion 55. That's on top of 8% growth that we had last year in the first half year. So we're growing top on top, essentially volume growth, 442 million. So we're very pleased with that growth number. And we feel also confident about the ability to continue to drive that for the rest of the year. Our operating profit, again, growing 26 million or 2%, somewhat muted because of the diesel cost that we have in there. At the same time, we're able to grow the profit through very disciplined cost control and initiatives to offset that elsewhere. So I think the business has done a good job in driving that efficiency improvement in above all labor and overheads costs that are there. And again, we elevate the net income to 5% growth or 66 million being at 1.378 billion in the first half year. And that comes essentially to let's see here, that's a 12.5% net income margin versus last year of 12.4%. So holding the profitability levels in terms of margin percentages, and in absolute terms, we are growing both top line and bottom line. The working capital is the same story as I said before. It's the same balance because it's an ending balance, but you see there that we're spending 500 million more than last year, and we're up to 2 billion in the first half of the year. All part of the investment plans and the announcement we did on 18 billion. You'll see that doubling up minimum for the rest of the year, and probably also next year and the year to come, is part of our approved investment plan that we are doing. And predominantly, those two components are affecting the free cash flow. So if I move into countries again, if we can look at, again, KSA being the absolute highest delivery of 375 million out of 442, but also good growth. Again, you see UAE, Kuwait, Jordan, Qatar growing nicely, Oman having this glitch from Q2, making it negative. And the same story on Egypt, where we have 32% first half year growth in underlying currency. The same component of hard currency delivery on the EBIT is the same there with high single EBIT margin. If we look at categories, you can also see good growth in fresh dairy. Here's where I think we feel particularly good, growing 4%, 153 million on fresh dairy. So if we take out the Ramadan impact you had in the second quarter, you see that we're growing nicely in our core segment on fresh dairy. But also very strong delivery on food with 128 million or 8%, poultry 59, bakery 57, fruit juice 34. And here on long life dairy, I think I need to say that this category description includes the Egyptian impact on three categories. On long life dairy, on fresh dairy, where we have yogurts and dessert in Egypt, and then on juice. So I want to reassure everyone, if we look at long life dairy, not including the devaluation impact in Egypt, it would be almost 52 million. So long life dairy in particular in KSA is doing very well. And then on channels, you have a more conventional depiction of the traditional trade, given that it's our lion's share of our sales, 249 million out of 442. It's 4% growth, but even more in percentage term in modern trade. But given that it's a smaller slice of the proportion, it's 119 million. Food service doing well. And the export, again, it's mostly the farming component that makes it benign in terms of the growth. If we then move in and maybe we can speed it up a little bit in summary, Ikram, for the net income.
Thank you. I'll go through it very fast. So ladies and gentlemen, the bridge is very similar to the second quarter that we just saw. So I'll go through very quick. Net pricing, again, this 100 million real discount is mainly driven by poultry segment, followed by long life dairy. As we talked earlier, cost of goods sold remain pretty similar when we can see farming commodities offsetting dairy commodities gain. The best thing is what you see in the middle of the page, very strong volume driven growth, 8% volume, driving 220 million of extra profit to the bottom line. And this is getting offset by 66 million of higher operational cost, which is given the fact that the diesel price increase went up. It's very good indication of tight cost controls. And then you see a lower funding cost driven by higher capitalization. If I go to the next slide, again, the story is 4% revenue growth, as we talked in detail on earlier slides. Operating profit is 2%, mainly because of transportation cost. And the net income is plus 5%, mainly driven by higher capitalization. If I go through segment by segment, we talked about the top line growth, which is 4% for dairy and juice, 5% for bakery, and poultry is plus 3%. When you look at the net income growth at the bottom of the page, it's about 100 basis point to 200 basis point lower than the top line growth, mainly because of transportation cost, which is impacting each segment. And that's the story of the first half for Almarai. Thank you. If I can please request you take us to the next slide.
On the balance sheet and our investments, again, coming back to the fact that we've announced 18 billion of investment over the next 5 years, and a lion's share of that is spent. It has been approved, but it will be spent this year, next year, and the beginning of 27. So the increase that you see here is completely in line with what we are planning. We are not spending more, but it is a heavy investment that we are doing. We are managing this with our internally generated cash, and we're actually quite happy with the progress. We are starting to see the beginning of the end on the poultry expansion, which is progressed very well. I think it's a big challenge to make sure the market works right and have yields that are very superior in the processing facilities, and at the same time doubling the capacity by building new constructs. So all of this is going according to the plan, and we're happy with that. If we look at the working capital, you can see that we are in percentage terms not excessive at all. We had an exceptional year in 24 when we managed to reduce working capital, and it actually contributed significantly to our cash flow. And if we go to the next page, you can see that in 24 you have 6 billion of cash flow delivered with changes in working capital. So obviously our improved profitability in the cash from the business was very good. But then in addition, we had favorable movements in working capital. Now we're a little bit more cautious given the geopolitical situation. And overall, when we can pull the levers again and start working on driving more efficiency here, we will, of course, do that. But we are in percentage terms, somewhere around 20-25% is where we've been also historically. And here you can just depict it. This is rolling 12 months. This is not the first half year. And you can see the OCF is 5.8 billion. Working capital adverse movement 600 gives a free cash flow of 500 million. When we also are including the heavy investments we do in plant, property, equipment, and then biological assets, etc. So it's really 500 million that you see there is the key. And then it's a question of neutralizing the net of loan, time deposit, funding cost, and dividend. We do have an impact in the quarter on net debt, but you should remember also that we paid a dividend that came out in Q2. So if we look at the metrics about our capital efficiency and our balance sheet structure, we're still suboptimal in terms of the leverage ratio that we talk about. We should be around 2.5 times. It's a positive problem to deal with, but essentially you see it go up here because we are in this particular quarter paying 1 billion in dividend. I should say also in relation to the PBIC acquisition that we've done, there is another 1 billion that will be added to the net debt post completion, which will bring the net debt EBITDA about 20 basis points up. But at the same time, we will continue to generate cash in the business, and we are confident that we can manage this level and even bring it further down as the business is generating the cash. On EBITDA and EBIT margin, this is again rolling 12 months and not the end of the period because we are at 15% EBIT margin, but the rolling 12 months is holding steady at 14% EBIT margin and 22% EBITDA margin for the rolling 12 with an ending of Q2. So holding the ratios is important for us as we are driving growth, that we do that with profitable growth at equal or higher profitability margins. Not too much to say about the debt maturity by age and type. More to come maybe later on that one, but it's fairly balanced. You see a lot of maturities over 5 years. That's deliberate, and we are keeping control of the structural debt. So I won't say much about the debt portfolio that we're having. It's well balanced. We might do 1 or 2 things going forward, but more to come when we can disclose that. And then on dividend, not much to say except that the dividend ratio or the payout ratio has gone down to 43%. We say we should be somewhere between 40 and 60% of net income. And you can see for the last year, that's been where we have been. This is a board of director decision on what to pay or what not to pay. The capacity is there to pay. Okay, so that's it. That was half an hour going through the results and let's say, the business performance. Overall, we are confident about the first half year. The second half year, we have good plans to grow, continue to grow, and we look forward to seeing the capacity that came that will come in for poultry. I know that you read that we've done some pricing. I want to be very clear, there's no discussion around dairy pricing. What we have done is in bakery for effective in July onwards. So the good bakery performance you've seen so far is volume related, in particular on bread segment. But we've done some pricing activities for bakery that also gives us good comfort for the second half of the year. And in addition to that, I also thought I would preempt a little bit questions that I'm sure will come up regarding the acquisition of PBIC, the water business for Ival and Oscar. First of all, I think we are very excited to move into this category. This acquisition aligns with Almarai strategy to expand into adjacencies. If you remember, our number one top priority is to grow in core markets and core categories. Given our market share positions and where we are in our categories, we want to expand and diversify our portfolio and tap into our competitive advantage that we have as a business. And we think this category is a very good fit to Almarai. Even if Ival and Oscar are very exciting and reputable brands, we should remember they are fairly young in the market, but they have grown over time very well. The acquisition is primarily asset-based because it allows us to secure a very modern production facility. So everything we will be acquiring is enabling us to have further innovations in this category. And we see this as a long-term strategy play. So if we look at their positioning today in the market, they're among the top 10 in the KSM market, which is a market valued at about 12 to 15 billion. It offers significant growth potential, and we aim to be in market positions equal to where our current categories are in the long term. I would like to remind everyone that we are very happy with the speedy approval from the competition authorities so that we are able to go ahead. But there are still some conditions in the completion of the deal that needs to take place. And we are confident that it will happen in the near future, but we will make a press release for the completion of the deal in the very near future. And prior to that, I do not want to get in too much into any financials about the deal. We've disclosed consideration price for the enterprise value. But this is a long-term investment for us. We are very excited about what we can do in this category. We think we can tap into our strong customer relationships, our supply chain expertise, our engineering capabilities. There's a lot of synergies in maximizing value or driving shareholder value that we believe we can do. And we're in here for the long run. So this is a very important strategic acquisition that allows us to expand our product portfolio offerings to the market. So more to come on that when we can, but I don't want to go through. I know I've received a lot of questions on financials, etc. We will come back to that when the time allows us to do so. So hopefully that gives you a good input to this. The deal is not completed, so please be aware of that. We are working rapaciously to make sure that all the conditions are met in the SPA that we have. And within the near future, we are hopeful that all of that will be resolved and we will be announcing when the deal is complete. So with that, thank you for listening in on this one. And we open up for questions and answers, please.
Thank you, management, for the comprehensive feedback. Ladies and gentlemen, we will now start the Q&A session. If you wish to ask a question, please click on the raise hand icon on your webcast, or alternately, you can also type in your questions in the chat box as well. For the consideration of time, we will appreciate that if you can all limit your questions to one, that will be really appreciated. Our first question is coming from the line of Ms. Nada. Nada, we are unmuting you. If you can introduce your company as well.
Hi, am I audible?
Yes, you are, Nada. Please go ahead.
Yeah, thank you very much. So I'm Nada from JIB Capital. So I have two questions from my end related to poultry. The first question is, how much of the negative net impact from pricing is related to poultry? And how much was the volume sold for poultry in the second quarter?
Yeah, so essentially, if you talk quarters of the first half year, I would say a majority of the pricing that you see, we have a lot of ins and outs depending on subcategories within the categories, etc. But a majority of this is poultry on the pricing. And then you were asking me, sorry, what was the second question?
The volume sold related to poultry in the second quarter.
We don't normally disclose that, but to give you reassurance, it was very healthy volume growth. It was almost 11%. So when I'm saying that the product offering is there and the consumers are buying our products, we see the growth coming. The category is also growing, but there is a fierce pricing and competition in the market currently. We are making sure that our Alyoum premium brand is priced above that level, but at the same time, we follow a certain span to make sure that we don't become too disparate in terms of the pricing range or the price piano that you have in terms of the price offerings. So we do activities to secure that the consumers are buying our product at a premium, but essentially underlying when we look at the business. And if we think about it a little bit more longer term than the quarter, we're confident about the product offering we have is good quality that people can trust, and they buy our products if they're available in the shelf. And we actually just sell what we can produce.
Okay, fair enough. Just to elaborate on this, if I'm not mistaken, I have asked this question or someone asked this question in the previous call. So I have the volume in the last year was around. So if I'm applying 11%, so am I right that the volume sold around 70 million bird this quarter?
That's
am I pretty close or?
You're pretty close. You're
okay.
Very well good math. Yeah.
Okay, fair enough. Thank you very much, gentlemen.
You're welcome.
Thank you, Nada. Our second question is coming from the line of Mr. Tahir Saifuddin. Tahir, if you can unmute yourself locally and introduce the company.
Taking my question. My first question, Danko, is really just from a top line perspective. 4% growth. Are you happy with this growth? Because just feel that Almarai is behaving more like a mature, developed market type of FMCG player. I think the question is really what would take the company to grow faster. And the reason I'm asking this is there's definitely a lot of moving parts. You've introduced a price increase in bakery. There's a poultry expansion coming through. There are some talks in the local newspapers about a daily price increase. So maybe you can just help us triangulate all of these things together in terms of how should we think about the top line growth. And the second question, which really is related to that, is the EBIT margin today on a TTM basis is around 14%. Well, you've mentioned before that you would ideally want to be closer to the 16% EBIT margin as a company. Again, how should we think about that trajectory? I mean, knowing that diesel costs have increased and maybe they will continue to increase, I just want to get maybe your thoughts on how should we think about the margin trajectory, maybe 12, 18, 24 months down the line.
Yeah. Okay. Thank you, Tahir. I think maybe we are a little bit a victim of our own success because this is the 15th quarter in a row where we have positive growth in our business. And you've seen some very stellar growth components where part of it had to do with the pricing activities we had to do to offset the inflation that was there in 21, 22. But then subsequent to that, we've had significant volume growth also coming and stagnated pricing or trying to hold the pricing. Overall, I think 4% in a quarter should not be looked at in isolation. You have to look at how much are we growing year on year, and are we having the right strategic move in the categories to drive that pricing. And I think we are, because even if you might feel that it's a bit benign with 4% on the first half year, we have a little bit of a planned backloaded year because of the poultry expansion plan. The facilities that we are finalizing is allowing us to produce more birds and sell more birds in the second half of the year. So we haven't had that benefit coming through in the first half year, and it was intentional and planned accordingly. I think if you look at around all our categories, we are, I think, growing healthy for several quarters in a row. And if you look at it for 2.5 years in a row, we have an ambition to continue to grow on that pace. And that's why you also see us doing it both organically where we can, but also through acquisitions. So hopefully with the completion of the deal structure, we will add another category. And that's a very key component that we can continue to drive top line growth profitably with adjacencies. Some of the initiatives that we have on the adjacencies, if it comes to ice cream, red meat, etc., it's all about growth. It's less about profitability because we have our solid brands and categories that contributes to it. But it's about us being able to expand those new categories into growth territories where we feel we should be entitled to play in terms of size. So I think there is a lot of activities in our 5-year plan or in our strategy when we look at it. Rest assured that growth is our number one priority. It is equally important that it's profitable growth. So when you refer to that I said 16% growth, I think you are not entirely quoting me right, because I said between 14 to 16% is where I think fast-moving consumer goods should have a return. And in that range, we should be there. And if you look at the quarter or even the first half year, we're at 15%. It's the rolling 12 months that makes it 14%. We tend to have, because of seasonality and the mix that we are having, that contributes less to the underlying EBIT in the second half of the year compared to the first half year. So overall, I think being at 14 and growing is a good achievement. Of course, we want to grow our bottom line more, but within that range of 14 to 16%, I think is a reasonable request from an investor to get that kind of profit ratios on the top line.
Okay. All right. Very clear. Thank you.
Thank you, Tahir.
Thank you, management. Thank you, Tahir. Again, just to be wary of the time, we will ask everyone to keep your questions to 2. Our next question is coming from the line of Mr. Patrick. Mr. Patrick, if you can unmute yourself locally and introduce the company. Patrick?
Hi, can you hear me?
Yes, we can hear you.
We can hear you.
Thanks a lot for the call. So basically, I think you have a 44 million one-off through disposal of this investment in the associates. So if we remove that, the numbers don't look that great. There is a 3% decline in the operating profit. The margins, the EBIT margin comes down to 14.5%. So I just wanted to understand this initiatives of price hike which you are taking. Will it kind of offset the decline in the margins which we have seen in Q2 in terms, right through the gross level? And on the poultry side, if you can just explain whether you are seeing some improvement in the pricing or, still there is an oversupply in the market and we should see the pricing pressure going to Q3 as well. So yeah, that's my question. Thank you.
Yeah, so it's an observant comment on the first part of the one-off, but a company of our size, it's not unusual that we have one-off components. In this particular case, it was a benefit that we had in the quarter. On the other hand, we also had a benefit last year in the quarter for a poultry subsidy that we received, a one-time benefit that you might recall. If I take out both of them, there's nothing wrong with the underlying profitability. And I'm trying to avoid to explain one-offs as much as I can, because I think the underlying business, and if it's doing healthy, is what investors want to hear. So I don't want to refer to this. That's the point of me not mentioning it. But in reality, the one-time benefit we had last year is equal to the one-time benefit we had this year. So if I take both of them, our underlying profitability is still very healthy in terms of the growth that I see. And then on the poultry one, I think that's a tricky one. It is very tough out there at the moment when I look at it's a contested, immature market. If we look at it strategically, it will settle down over time. The protein on poultry is something which is very healthy, considered very healthy. It's also driven in the Saudi vision of consuming more healthy proteins. Poultry is one of them. Seafood is another one. And as the market starts maturing more and more, you will also see a price convergence, I believe. Like if you look at dairy today, there is one price. But at the moment, there are, how should I put this? There are single poultry producers who don't have the benefit of a diversified product portfolio like Almarai that has to get volume. And you can see that being done by activities which I think are not sustainable in the long run. So if you want to be in the business in the long run, you have to work on the underlying components of the product offerings, making sure that the quality is right, and then ensuring that consumers are buying it. What makes me reassured is that the category continues to grow, and it is a very healthy protein. There is a lot of players in the market that are competing at the moment. And every now and then I see some pricing activities that are below the cost of producing. And we don't want to go there. And we see that our consumers are still buying our products, even if we are priced a little bit above what's going on in the market. I don't think it will go away immediately. It will probably continue to be there. And therefore, the metric for us to look at primarily, if we look at it strategically, is our underlying volume growing or not? And we are very healthy in the underlying volume growth. So we will have to wait this out. I think there will continue to be issues in the second half of the year and maybe also beginning of next year. But in the long run, we see we are actually not worried about it. It will mature. This market will become like any other market with, I think, adequate return requirements that are needed for this type of business.
All right. Thanks a lot.
You're welcome.
Thank you, Perfect. Now we'll be taking some of the questions from the Q&A chat box as well. I will be merging a few of the questions just to be wary of the time. There are a couple of questions about the gross profit and the gross margin that has declined from in Q2 versus the Q2 last year. Could you clarify what specific cost factor contributed to the decline in the profit as well as the margins?
Yeah, in simple terms, I think there are 60 basis points of deterioration that you see in the gross margin, both in the quarter and year to date. And that could be easily referenced to the point that Ikram was making about we see feed raw material for feedstock coming down, but ingredients are continuously high. So if we look at butter, for instance, and the price for butter, unfortunately, we have a negative impact on ingredients components to the dairy food category that affects us. Not significantly, but it does affect us. Then the other thing is mix. Pricing, if we look at our categories, very different average sales prices. So in the poultry segment, we had a higher proportion of frozen poultry sold than fresh poultry that is on a different price level. So when I say mixed issues, these are essentially points that goes up and down depending on the performance of the quarter. But those are the two key reasons. I don't know if you want to add anything to that, Ikram.
Well, that is the transportation cost, which does impact our gross profits quite significantly. And that's also resulting in the reduction that we've seen from the 1st of January.
Yeah, so we made an announcement earlier in the year of an impact of about 200 million full year, and we have about close to half of that already now in the first half of the year. So I think maybe it's good to look at the total P&L when you come down to the EBIT margins or the net income margins, because we are offsetting a lot of that, not necessarily in the right line items. When you look at the P&L, it can go to indirects or below gross profit. But a lot of good initiatives are being made, considering that we do need to take into account that diesel costs might continue to increase in the future. So that means we're doing a lot of work on cost-benefit analysis of alternative sourcing on energy. And some of those activities we've implemented, some of them are more long-term. But I think that's wise for everyone to look at alternative energy sources, because we are expecting that to continue to be a cost item that goes up. And that's not only affecting Almarai, it's affecting us all one way or another. So we are pleased to see the mitigating effects, but you won't necessarily see all of it coming through in the gross margin.
Thank you, management, on this. There are a couple of questions related to other income, and I will club all of those in together as well. The question is that there seems to be a one-off gain of Saudi Riyal 43 million related to sales of investment in associates in Q2, excluding which net income would be lower, operating expense also higher. Is that understanding correct?
Yeah, it comes back to what I mentioned before on the question about the one-offs, that we had a benefit this year, but we also had a benefit last year. So overall, they too are in the same level. So if we take them out, the underlying performance is still improving. So, and again, I did not want to make references to one-offs. I know that it's not particularly appreciated, but that's the reality of it. We had a fairly large one-time subsidy that we received last year, and now we had another that gives the credit to the P&L. And without them, the underlying performance is still doing very well.
Management, there are a couple of questions related to the acquisition of Pure Beverages. If you wish to take the questions, I will pass it on. Otherwise, I will be skipping them. Pure Beverages. Management?
I believe that was addressed by Danko already when we finished the Q&A. Sorry, Danko, please go ahead.
No, I don't know the question. So please, if you want to ask something, if I haven't already answered it.
Post the acquisition of Pure Beverages, will the beverage portfolio be positioned as a primary premium offering? Also, how much revenue contribution is expected from this category?
Yeah, as I was saying, I don't want to go into specifics on numbers, but the 12 to 15 billion water market is a big market. We also know that in our line of business, people need to eat and drink. So we think it's a very stable category. And if we do it right, it comes down to what I think goes back into the Almarai product offering that makes us unique in the market. it's quality you can trust. It's equally important in poultry, in fresh dairy, as it will be in water. I think the company, PBIC, have done a really fine job in building the foundation for that, and we will take it even further on that, in that line of product offering. If you get the consumers to prefer our brands, which I'm sure they will, in the long run, you will see a preference for consumptions with our brands. That, of course, also will be reflected in the pricing.
Thank you, management. Again, there is a question related to revenues from the other activity segment declined in Q2 25 compared to the same quarter last year. What are the reasons behind the decline?
Yeah, that's again, I think I answered in the beginning, where you saw that we again had this one-off very large sale of corn and soy to a third party last year. It's essentially farming, poultry farming, whereby you don't have it this year. So you have this anomaly where you have a negative component to last year. But it's a comparator issue. These items are not products. These are raw material with a very different margin. So it's not really affecting our profitability at all. In fact, it's enhancing our margin. It's accretive because of the overall mix of selling these products are not there this year. So overall, this is a farming-related item from last year. Hopefully that's well enough explained for you.
Thank you, management. Modern trade grew 8% in Q2 2025, up from 2% in Q1. However, it stood at the same level in the last few quarters. Can we expect a similar growth trend in the coming quarters? Also, how does this channel impact margins across different product categories?
Yeah, so I think I also mentioned this in the beginning, so I won't be long on that. But modern trade is very important for us, and we also need to balance the different desires between our different channels. Traditional trade, we have an extremely good coverage of traditional trade, and it's very, very important for us. But so is modern trade. But it's a very different type of channel where you work a lot with retailers on what we call gross to net. So the support that we give to modern trade to get return on investments for the activities that we do in modern trade. And what we've done this year is more focus on the support that we give between gross and net. So we are very pleased to see that we are growing in modern trade. It's a key channel, as you all will agree on. And we will continue to focus on that to continue to have more growth in modern trade. Part of that relates to also making more profitable growth in modern trade. And that's where I don't want to give any predictions for the future, but it's a key focus area for us. For those of you who also operate or do analysis outside, let's say, the region, you know that this is a very tough area in Europe or in the US. And it's important for us to have good partnership with key retailers and making sure that we win with winning customers by getting a return on the support that we give. So modern trade is key. We have more focus on the support that we give that actually allows us to get more growth within our segment, but also for the retailer themselves with the product offerings that we have in play.
Thank you, Danko. There are a couple of more questions regarding the net pricing impact on Q1 and Q2, but I believe that you have already explained that quite a lot related to poultry segment. I will be skipping on those questions. Then there are questions coming from Abdulaziz on Egypt, 30% underlying LC local currency growth. Can you please elaborate how much comes from pricing and how much is from the volume?
Maybe you can help me here, Ikram, but I believe almost everything is volume.
Thank you. You're spot on. So most of it is driven as by local volume. There is some reduction in export volume, but the local currency, local growth, and the market share in the local currency remains very robust, and we're very positive on the Egypt future going forward as well.
There's a question from Mr. Adnan. What is the volume growth in H1 2025? Ikram mentioned 6% for Q2. Maybe I missed the H1 number.
Did you ask
It was about
or
the volume growth.
volume growth for Almarai?
Yes.
it's around 8% for the first half in totality.
Thank you. Then there are questions about poultry pricing, specifically in the second half. Again, we will skip on that as well, given the management has already talked about it as well. What is the expected impact of the price increase in bakery segment in SAR terms? If you can elaborate on that.
Yeah. So overall impact, if we look at the bakery price increase that we're doing now, some of the price increase that we do, we will use to support the brands as well, because we want to have more growth in volume for the bakery segment. And we are mindful about the implications. Sometimes the correlation between price and volumes, you have to be mindful around it. But approximately 150 million is what we are seeing, 150 to 200 on an annualized basis is the impact that we have on bakery.
Thank you. There is a question that's coming from Mr. Ani Gul Marbat. What will be the impact on poultry segment from recent ruling on bakalas not being able to sell meat, given the company's reliance on traditional trade for major portion of their sales?
Yeah, I think this also something we looked into, and it's, I think the restriction lies on bakalas that have a square meter less than 24 square meters. So it really doesn't impact us materially in any way or form because of the restriction being to very, very small bakalas. So I think if you read the fine print of what is actually being introduced there, you'll see that it really is trying to aim towards the very, very small bakalas that have a space close, well, smaller than an office room if you're in my position. But then essentially we monitor that, but it's not any major impact for us.
Thank you. As we are already over time, we will just be taking last two questions from verbal questions, and I will advise or ask the questions to keep it at one. Ms. Dua, I'm unmuting. If you can unmute, if you can introduce your company as well.
Hi, am I audible?
Yes, you are.
Hi.
Hi.
Just a quick question on the bakery price hike. So assuming commodity prices remain at current levels and nothing changes, and assuming, as you just mentioned, Mr. Danko, that the impact will be 150 to 200 million on an annualized basis, should we assume that second half margins will be better? Because it will almost offset diesel cost.
Well, because you have a lot of variables in this, there are reasons to why we do price increases, and some of the components that are yielding the additional revenue and profit are also going to be reinvested. So you won't see like-for-like comparison if we look at the total Almarai performance. We use the means to drive the category further for a long-term perspective. So when I make this statement, it's pure sort of math of doing calculations, but we don't want to lose volume because of that. So a lot of investments will be made also to support it. There are many other means for us to mitigate the diesel cost, and a company of our size always have efficiency programs to drive and make our cost structure even more lean and efficient. And we have a lot of initiatives in place to drive them, and very good ones too, that really energizes not only me as a CFO, but as business, the focus is really good. So we have a lot of levers to drive profitability to offset the diesel. You should see pricing in bakery as something we do to invest in bakery, to drive growth in bakery even further.
So in other words, we shouldn't assume improving margins for the second half.
I wouldn't, I mean, if you want to squeeze it into an Excel sheet, I wouldn't do that because there are different variables that comes into play. And hopefully through the quarterly announcements, you'll see what we'll do. But we are confident about our growth plans for the second half of the year. When I talked about being backloaded in terms of our plans, a lot of it has to do with poultry. So you look at the category play and what we will do, and we are ambitious in the second half of the year to make another record year in Almarai. And if everything works the right way, that's exactly where we are heading.
Okay, very clear. Thank you so much.
Thank you.
Thank you. Just to remain mindful of the time, we'll be taking our last question that is coming from the lines of Mr. Igni or Miss Igni. Apologies if I mispronounced your name. If you can unmute yourself and introduce the company.
Capital. So my question is about the subsidies that you received in the first half of this year, whether for the dairy or for the poultry segment. Thank you.
Yeah, maybe you can.
Sure, Danko. So subsidies we received are slightly lower than last year. And that's mainly because the dairy subsidy is coming in play. No issues on that. But as Danko mentioned, we did receive a one-off subsidy last year. So like on like, we are about, I would say, 30 to 40 million lower on subsidies received for the first half versus the same period for last year. But the program continues as is. We are seeing no disruption on the dairy front. Poultry subsidy remains very limited, but it's still continuing in the current year.
So can you give us an estimated figure for the amount that you received in the first half?
We don't disclose that. This is only disclosed on an annualized basis. You can see in our annual report that we do disclose it. But I think the more critical point is to understand the difference from year to year. And this is done on a uniform basis. So if we are Almarai receive, let's say, close to 330 million of subsidy, it will be fairly uniform for each quarter because it follows an accrual methodology. So in that respect, Almarai recognized between 60 to 70 million each quarter, and that's fairly uniform, except for poultry subsidy, which is very sporadic. You only receive when you receive in cash, which is a small percentage.
And I think the overall bigger picture should be that subsidies are, of course, good to get, but in reality, we are not in the need of the subsidies in that respect. If you look at our underlying profit as Almarai, the subsidies are a very small part of that. It becomes much more relevant maybe if you look at smaller players who are just in one segment. If it, for instance, is in poultry and who are perhaps not having the benefit of the size of Almarai, then it becomes very, very relevant. But in our case, a perfect market with free pricing and no subsidies is essentially ideal. But of course, we're grateful for subsidies that we do receive. But it doesn't materially impact our underlying profitability if I look at it.
Okay, great. Thanks so much.
Yeah, I saw that we were up to about 162 attendances. So thank you very much for calling in and having such an interest. And maybe we'll extend the period if we see the same level of interest in the future. But please do not hesitate to connect with investor relations on questions you might have. We have a good department there that allows you to get more clarity on questions that you might have that you feel were unanswered this time. So please feel free to reach out to our investor relations department for more answers to questions you might have.
Thank you, management. With this, we will close the call. SNB Capital would like to thank Almarai's management for taking the time to conduct this call. We would also like to thank all the participants for attending. We wish you a pleasant day. You all may disconnect now.
Yeah, and by the way, I wish you all a good holiday and looking forward to seeing you all in our third quarter results announcements that will come in October. Thank you, everyone, and goodbye.